You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Welcome, everybody. This is Buck Joffrey with the Wealth Formula Podcast. Now, before I begin with this final series of Ask Buck, I have to tell you, if you have not done so, check out wealthformula.com. Sign up for one of our email lists. Sign up for Investor Club. You've heard lots of reasons through these Ask Buck shows why that will make sense if you are an accredited investor. And the other thing to consider is to join Wealth Formula Network so that you can have these conversations live with me and the rest of the folks in Wealth Formula Network, and also get some additional training through our course. You can go check that out at wealthformularoadmap.com. And when we come back, we are going to go to part 3, or sort of the third and final Ask Buck round for the last 3 or 4 months of questions that have been sitting around. All right, welcome back to the show, everyone. Let me get started. Let me not waste any more time and get through these final questions, because I think I want to make sure that we've got a fresh plate, so the next time we do Ask Buck, I'm not like 3, 4, 5, 6 months behind. Okay, so the first question we have is a recorded question from Ileana, and here we go.
Hi, Buck. I would like to know what you think about buying gold and silver as part of adding that to one's portfolio. Thank you.
Okay, well, Ileana, thank you for the question. Bottom line is, I am not a gold bug or a silver bug or precious metals guy. I'm just not. Now, gold bugs become very upset with me when I say this. But let me just say this. I understand why they're doing it. I don't see personally, I don't see the value after what I kind of understand. And so it doesn't really belong in my portfolio. But listen, guys, I have a lot of respect for, like Robert Kiyosaki, will be on the show. He's going to be on the show in a few weeks here. He's a huge gold bug, and I have nothing but utter respect for him. And he could be completely right. I could be missing something. But here's the thing. This is how I think about it. Most people own gold as a hedge against inflation, right? If you ask them, that's their main reason. It is, gold is like the anti-dollar. Gold holds its value, over time. An ounce of gold bought you a toga and slippers in the times of Christ, and now it'll buy you a nice suit, pair of shoes, or, a nice dress, I guess, if that's what you prefer. But if you are buying gold as a hedge to inflation, then my question to you is that, isn't any real asset a hedge to the dollar? I mean, what happens to rent during inflation, right? Say you own some apartment building and there's inflation. What happens? Well, rent goes up, doesn't it? So wouldn't owning multifamily real estate also be a hedge against inflation? I mean, your cash flow goes up, the property, and therefore the value of your property goes up. And, here's the other thing about real estate during inflation that you don't get with gold. Since most real estate is acquired with debt in the form of a mortgage, the debt that you have becomes washed away. Now, that's a really important point. So think about this. If you borrow $1 million today, and you have that as a mortgage, with inflation, that $1 million will have less buying power in 10 years. So essentially, inflation is destroying your debt, right? So this is a really important point, and one that you have to think about in the macro economic sense as well, is why we know that this trend will invariably, continue. Inflation, that is. So, for example, think about the government. I mean, why do you think that the Fed wants inflation? That's one of its mandates, to have inflation, and it's scared to death of deflation. Well, because without inflation, we couldn't pay our sovereign debt, right? We would default on debt, right? So we need inflation to make up for sluggish GDP so we can keep taxing people more money more dollars than is needed to pay our bills, right? So it's sort of inflation in that regard is sort of it's a silent tax, one that you don't see. So when you own real estate, you're basically doing kind of what the government's doing. You're not only getting the hedge on inflation like you do in gold, but your debt is being washed away by inflation simultaneously. And don't forget, the real estate is also incredibly tax efficient, while gold tax laws on sales, etc., are downright punitive. All right. So anyway, I'm not in the business of giving financial advice, but that's why I don't own precious metals. I'm not a big fan. I have yet to have someone explain why, I should buy precious metals based on what I'm saying now, but I have not found it. And if you think about it, this is kind of what a lot of the countries, these countries that are trying to, get money get money out of China, for example, et cetera. They're just going in buying like 25, 30, $40 million apartment buildings. They're just buying them cash. So effectively all they're doing is they are buying a $40 million piece of gold, right? That's what they're doing, one that happens to cash flow. All right. Well, anyway, again, please don't send me hate mail about gold. We've had this discussion several times. I've had several people on the show about gold. So if you are a big time gold bug, we can agree to disagree. The key thing is that you think about it and you come up with an opinion for yourself. All right. Next question is from Brandon.
Hello, Buck. This is Brandon Kemp in Portland, Oregon. Number one, love the show. One of my favorite podcasts of the dozen plus that I follow routinely in the real estate space. So thanks for all that valuable content that you put out there for us. Listening to your Ask Buck segments, which are dynamite, by the way, made me start to think a little bit more about some topics I personally like to dive into a little deeper. And I was listening to a Whitney Sewell podcast this morning where they were touching on capitalization rates, obviously at the entry, but I'd love to learn more about how one targets a future exit cap rate and how different market conditions can affect the cap rate out of our control, in our control, and how NOI ties all into that. I think a deep dive into just that could be a whole show segment, in my opinion. Thanks again, Buck. Look forward to your next episode.
Well, Brandon, thanks for the kind words and for the question. For the experience, and so that everybody knows what we're talking about, let's talk about what a cap rate is. A cap rate is, of course, simply the net income of the property divided by the purchase price of the property, assuming that there's no leverage, that there's no mortgage. And that gives you sort of this baseline yield or capitalization rate. That's what people call cap rates. Now, cap rates are dynamic, right? They're based in market, what the market is, and they're different for different markets. They're different based on interest rates. They don't tend to change particularly rapidly. They also tend to get lower with lower interest rates. Why? Well, let's think about that. So leverage only helps you if the interest rate of a mortgage is less than the cap rate, right? Again, let me say that again. Leverage only helps you. Mortgages only help you if your interest rate is less than the cap rate. Because if that happens, if your interest rate is less than your cap rate, you're going to magnify your gains. On the other hand, if your interest rate is greater than your cap rate, then you are going to magnify your losses, and that is not advisable. So, cap rates are somewhat limited in that regard by markets depending on what the mortgage interest rates are. So, with regard to coming in and examining cap rates when you're looking at a deal, say you're a passive investor or limited partner, it's become increasingly difficult, particularly in an environment of compressed cap rates. But, the thing is, an incoming cap rate is less important for kind of what we do specifically in Investor Club, which is value add real estate, it's less important because what we're really trying to do there is seeing how much we can get the value of the property to by increasing rents and decreasing expenses. And in that regard, the value add delta is really, really the most important aspect of it. Obviously, buying something at a better cap rate is going to give you a better profit margin. But I'm just telling you this because this is something that is pretty critical. Value add real estate, the cap rate becomes a little bit more subjective on what you're willing to accept on the incoming side, right? Because what we're trying to do in value add real estate, once again, is to crank up net operating income and dynamically increase cap rates, right? Dynamically increase the yield. As for exit cap rates, right? The cap rate that in a pro forma, you might see somebody saying, well, this is the cap rate we're thinking we're going to sell it at. Well, they're really only important if you want to sell your property first of all, right? If you're cash flowing and the market cap rates become decompressed, in other words, you could sell your property, but you won't get as much money to a point where you're not happy with the profit, then the fact that you've cranked up your net operating income and you're getting this cash flow on it, well, just keep your cash flow, the stuff that you earn through your value add program, right? And the thing about it is when you're talking about evaluating exit cap rates, what I will say is that no one can really predict cap rates, right? You really can't. 5 years ago, people said they couldn't go lower. Guess what? They went lower. Why? Because interest rates have gone lower. And again, that's why cap rates have gone lower. So right now, let me ask you this. Do you think it's more likely that we have higher or lower interest rates over the next couple of years? Well, to me, they're not getting any higher in the next couple of years. That's for sure, right? In fact, the real question right now is whether or not we're going to go to negative rates. And so the Fed, there's no way the Fed is going to raise interest rates right now. So based on that, you could see actually some potential, some further compression in already historically low cap rates. Now, as for the pro formas on the exit cap rates, here's the thing. Most syndicators, reasonable ones, are going to assume an exit cap that's similar to the one going in, which I think is acceptable because they're just not trying to predict the future. There are some syndicators and some in our group, which if you are part of Investor Club, you've seen where we'll give you a range of exit caps that are based on maybe what, historical decompressions, et cetera. Now that again, even though you're getting those, you still got to take them with a grain of salt because who knows, right? The only thing to be really wary of, in my opinion, when it comes to an exit cap rate is one that is projected, purposely lower than the entry cap rate. Because even though somebody might believe that, in that case, the operator is really trying to push up their numbers and might be taking that pro forma and, as they say, putting lipstick on a pig, which I have seen as well. Okay, next question. Next question from Ethan. The question is, and this one's obviously old. Bernie Sanders has been discussing federal rent control and combating gentrification and speculation. Could you discuss the implications of this for investments such as Western Wealth? Thanks. So again, Ethan's referring to one of our partners in Investor Club where there's a big value add business model. They've been extremely successful, 30% annualized returns on average out of 32 divestments. Just a really solid group. We're doing really well even through this crazy COVID-19 pandemic. But here's the thing. So their model is based on this whole value add thing, creating value, net operating income. And so, Ethan, your question is a good one. If all of a sudden the federal government said, okay, well, you know what? We're not going to allow you to raise rents anymore. How much of a problem is that going to be? Well, obviously it would be a huge problem, right? It would be a huge problem. But fortunately, Bernie Sanders is out of the race. And I don't think anybody in their right mind on the federal level would do that, because I think what it would lead to is, not only a huge crush of real estate markets and significant problems for the economy, but also what ends up happening is that, listen, what drives a real estate entrepreneur to improve a community? It's the ability to increase the value of a property. So, could they have certain sections that are maybe more rent controlled? Well, you already see that in California and New York, et cetera. That's certainly a possibility. But I have a really hard time seeing this as something that we need to worry about in the near future. Unfortunately, I don't think. Unfortunately, Bernie Sanders is out of the race now anyway. And if it's a Biden presidency, there's no way. He's just he's too much of a moderate to do anything crazy like that. By the way, this is the reason why rent control issues and state government laws and things like that are one of the reasons we never do in Investor Club, or personally just myself. I never invest in real estate in California or New York or any of those states that are frankly, they're it's nothing to do with the politics other than that they're not landlord friendly or business friendly. And so we try to stay away from those, and we stick to places like Texas and Arizona and, places that are business friendly, and that these kinds of things would be, virtually impossible unless there was a wholesale change in the population. So next question, how is return of investment treated for tax purposes versus return on investment? That question is from Ravindra. The question, actually, it's a pretty simple one to answer. It's the return of investment is not taxed. So, if you have some sort of refinancing event, that's your money. You're not going to get taxed in it. So we brought up Western Wealth Capital a couple times. So in our syndication model, there is income from cash flow that is sheltered by depreciation. And then, you have these refis, they average around 18 months for full capital return. And in those situations, that money is coming back to you again in the form of tax-free money. Now, the tax you do pay typically is, again, long-term capital gains. If you're a limited partner, and again, you may have some depreciation recapture. But again, of course, as we've discussed previously, if you use the whole golden hamster technique and you reinvest those into more property and you get more depreciation to offset those gains, then you may end up not ending up paying taxes even on exit. That, of course, is what we call the golden hamster wheel, which I would refer you to multiple other episodes of Ask Buck if you don't know what that is. All right, let's see. Okay, the next recording here is from Brett.
Hi, Buck. This is Brent calling from Israel. I listen to many financial and investing podcasts, and I've learned from each one of them. There's only one podcast that, having listened to it, resulted in literally thousands of extra dollars in my pocket. Through Wealth Formula and Wealth Formula Network, you introduced me to American homeowner preservation, as well as syndication opportunities that you have vetted. I followed your lead, invested, and am making good money and increasing my velocity to grow my wealth even more. Thanks, Buck. I'll continue listening each and every week.
That's very kind of you, Brent. Appreciate that, especially coming from Israel. It's so interesting. We have a lot of people, throughout the world who listen to this. So we have a number of people in Israel. And if you come to a Wealth Formula meetup, which hopefully we'll have again one day when there's herd immunity, you'll see we had people from, I think it was like Australia, and we had a couple people from Israel. Pretty neat. Anyway, it's good to hear that it's helpful to you. Again, Brent is referring to a couple things. He's referring to our investor club, which you can sign up if you're an accredited investor at wealthformula.com. And he's also referring to the online community, Wealth Formula Network, which we've discussed before. This is the place where, if your friends, family, and neighbors don't want to talk about the stuff we talk about, you can join this community called Wealth Formula Network. It starts with a course with a bunch of really smart people to get the basics down, and then you're part of a online community, as well as a community that does a bi-weekly Zoom teleconference call, video conference call, I should say. And by now, everybody knows Zoom, so that should be pretty obvious. You can check that community out, that whole thing, if you're interested, at wealthformularoadmap.com. Thanks again, Brent. Okay, next question is from Cindy. The question is, hi, Buck. I've been listening to your podcast for a while. Got a rookie investor question for you, though. What is the difference between a REIT and a syndication, such as one with Western Wealth Capital? Both focus on real estate operation. Investors in both don't have control over the business and give their full trust to the operators. Both REIT and syndication offer some dividends. Value of REITs go up too, although it may not go up as much as exit strategies in the syndication, but seem more liquid as it's publicly traded. I'm assuming we don't get bonus depreciation for REITs as we do in real estate syndications. Although if we are not real estate professionals, we can't use the bonus depreciation anyways. Thanks in advance. Well, first of all, that's not true. You can use the bonus depreciation against any other passive income. The key is building up passive income, right? So that's not true. We have a number of people in our group who've created enormous passive income flows that are offsetting with bonus depreciation. One thing that I have seen on multiple occasions is, doctors who have either surgery centers, infusion centers, nephrology type, dialysis centers, etc. They're passive income, and these losses can be can potentially offset income from that. So that's actually not true. You can get a tremendous benefit from that. But otherwise, listen, it was a good question. Investing in REITs is essentially investing in a big clunky Wall Street fund, right? As you mentioned, there are some tax benefits, and you have liquidity, but these REITs aren't going to squeeze nearly as much a profit out of these of their real estate as you get in these sort of more private syndications, right? And you're not going to be doing some of these things that are really investor friendly, like bonus depreciation, et cetera. REITs also tend to only invest in stabilized assets, right? They're not really in the business of value add. They're not nimble. They're just there to provide modest returns to investors. So they're not going to get into value add. So that creates some level of stability, but it makes returns pretty flimsy, right? So 4 or 5% return in a multifamily REIT, it's actually probably pretty good. Whereas in a syndication, as you know, we generally look for annualized returns targeting 20% or higher. So in general, I will just say this, that I don't think that that REITs are evil, and I think the underlying assets are obviously good ones, but I don't like funds in general for real estate because of an inefficient use of capital. Imagine that, like you have to wait for money to come in before you can deploy it, right? So I don't like that anyway. I like asset-specific syndications where things are really lean. Whereas in a fund, until the money is put to work, it just sits there lazy, not making any money, right? So now put this kind of lazy money into the hands of a big, Wall Street fund that makes money based on assets under management. Well, it's a completely different paradigm. It's a completely different investment strategy than the types of syndications that we do in things like Investor Club, where we're doing private placements. Now, there is one thing I do like about REITs, though. I like to sell REITs property. Okay, that's what I really like to do. So an ideal situation might be where you get a portfolio of 8 to 10 buildings in an area. Say it's in Phoenix, or maybe they're all in Dallas. And if you sold them individually, maybe you'd be selling them at a cap rate of 5.5 or 6. But because it's a REIT, you will get a premium for selling them all of those buildings at once. You might be able to sell that for a cap rate of 4. Why? Because they don't want value add real estate. They want property that's already stabilized, and they don't want a lot of problems. So in order for those conveniences and for the convenience of picking up, if they want to get into a new market, they pick up 2,000 doors at once by buying your portfolio of 10 apartment buildings, they're willing to pay a premium, and they always do, because they don't need big yields in return. So that's one of the strategies actually that we use in our group is we try to we buy a bunch of properties in any given area. And then when we sell them, we don't sell them one at a time. A lot of times we'll sell them in a group of, 5 or 10 at a time, and investors benefit from that. Anyway, that's that's the long and the short of it. I think REIT's a completely different animal. It's not something that I would use necessarily as a way to create wealth. Maybe to help maintain, preserve wealth over a period of time. Maybe it makes sense, but that's about it. Okay, let's see. We have one more recording.
Hey, Buck, this is Ryan. Just wanted to thank you for all your help and congratulations on 200 episodes. Saw you first, or heard you first as a guest on another podcast. Started listening to your podcast, then became a member of Investor Club, and after that, Wealth Formula Network and the Wealth Formula Roadmap. Started going to the meetups then also. I've always found your content to be valuable, relevant to me, insightful, and now finding that the quality of the group, the network, is very high. So thanks for all that you've done over the last couple of years. Congratulations on 200 episodes, and I look forward to more. Thanks.
Ryan, again, that was really nice of you to leave that positive affirmation for me. It is good to hear, and I do think that we've created a tremendous community. That's it for my question answer session here. We'll be right back after these messages. Welcome back to the show, everyone. I hope you enjoyed that series of Ask Buck. We are now officially caught up. If I, for some reason, omitted your question, I apologize. I either lost it or it was something that maybe I couldn't necessarily address on the podcast per se. But I love it when you guys ask these questions. Go ahead and start piling them in again on the Ask Buck. You go to wealthformula.com and, I prefer the recorded ones because it makes you kind of, makes it more real. But, if you don't like that, you can certainly send emails over with your questions or comments as well. The last one was a comment from Ryan, of course. Ryan is a member of Investor Club, which, again, we've referenced several times. It's where the magic happens. You can sign up for that at wealthformula.com. The other thing, again, I'm just going to hit home again because people who like these types of forums, you would love Wealth Formula Network. If you're interested in taking your knowledge to the next level, having an online community, talking, to people bi-weekly on a teleconference about these real issues and bringing your own issues to the table, in addition to a course that gives you a strong background, go check out your Roadmap to Real Wealth, which is that course is on wealthformularoadmap.com. Again, that's wealthformularoadmap.com. It's a course, but the Wealth Formula Network is the thing that I think that you really probably will show you. It's the gift that keeps on giving. Anyway, that's it for me on this episode of Ask Buck and for this series of Ask Buck on Wealth Formula Podcast. This is Buck Joffrey signing off.
Thank you for listening to the Wealth Formula Podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, consult your own financial team before making any investment. See you next time.